right, welcome back to accounting. So we finished up chapter 5, which was dealing with purchasing our periodic inventory, okay? Now that chapter 5 is over, chapter 6 is what happens when we sell our inventory and we are selling the products that we track as periodic. Now, if you remember the definition of periodic versus perpetual, right? Periodic, we don't keep track of it all the time, meaning we will only do it every once in a while. So that's why it's very, very important to know that you have to take a physical count of inventory, right? Because these items that you are currently selling, you don't care to keep track of it because maybe it's not the most popular product that you're selling on your shelf. Maybe it's something that it's for special orders only, where you know that you only have a limited amount of items that it doesn't get sold all the time, right? It's not a frequent sale. So in this case, that is something that you have to keep in mind, okay? And this is what we do when we have to deal with periodic sales, right? So let's talk about sales once again, right? Sales is, again, once is the nature of the business where we take our natural resources and we provide a product to our consumers, right? That's the whole goal of the nature of a business, is to make a profit, right? We talked about this in chapter 1. Now, in this case, right, how do we make a profit? Well, now that we figured out how much it's going to cost me, right, which is going to be, the purchase price, anything that includes, such as shipping and handling, any type of cost that gets the asset to the store, right? Those are all going to be considered costs for putting onto the product, right? That's what it cost me to actually retrieve and be able to obtain the items for me to go ahead and resell it to my consumers. Now you also have to remember, right? We also have to add in a little extra to make a profit. So again, the goal here is to essentially purchase the product with cash, right? And then create a selling price, which is going to be the cost of getting the entire inventory asset to the store, and then add an additional profit percentage, okay? Or a profit margin, whatever way that you guys understand it as, right? Profit percentage is going to see how much percentage of sales you want to increase the product by. Profit margin is what percent or per dollar that you are trying to increase your profit by. So that is the most important thing, because this is how we make a profit. And here's one thing that we have to also know too: because we are living in the state of Nevada, we are obligated to charge sales tax, right? So for this class, sales tax back in 2019, 2020 used to be 8.25%. Now it's 8.375%. So as of that, I don't want you to be know any complicated numbers, because it will depend on the state and the actual city, county that you are doing business in is going to determine the sales tax, okay? So again, great example, LA tax versus Orange County tax. They are 1% difference. Why? It's not because of the state that they're doing business in, it's the county, okay? The county charges an additional extra percentage. So again, what makes up sales tax? It's usually a percentage goes to the state, okay? And then a portion goes to the local city and county, okay? So in this case, that's what makes up sales tax. So as obviously you can see, you could tell that San Francisco tax is definitely way higher than it is to be being charged regular tax in Southern California, right, in Orange County. So those are two complete different things. Or Fresno, right, in the central California. They are all different. So you can expect that here in Nevada, you can tell that Reno is going to have different percentages than it is going to be here in regular in Las Vegas. Okay. So
Okay, Lee, being that we're in Las Vegas and you say about the different tax ranges, does uh, Las Vegas charge a hospitality tax?
no, usually that's called gratuity. That is based on depending on what kind of service they're being provided. So most, if you go to a lot of restaurants, and if you go, let for instance, right, you go eat and you're in a big huge group of people, right, they can charge you gratuity, which isn't a tax. um but yes, in that kind of cases, because there's a large group of individuals and they're providing a service to you, so they may charge a gratuity fee, but it's not a tax. Right, it's not a tax. Now if you're thinking about the strip and the hotels and things like that, now in most cases, right, if you rent out a hotel room right on the strip, they do include a hospitality fee, but it's not a tax, okay? It's not a requirement for city, state, or anything like that. It's just a requirement of a fee that they charge to keep, maintenance and being able to afford to pay for their employees. That's all it is. It's just an additional fee. It's not a tax, okay? All
I
right.
wish they that in South Carolina because like if you go in one area that has the hotels and everything like that,
Mm-hmm.
other businesses and the hotels will be charged under a hospitality tax.
Wow.
That's it. Like if I, like in one instance, like I used to work at KFC, and they happen to be in the area where there's a lot of hotels and stuff like that. Whereas the city of Charleston would pay 7%, and then
Wow.
the other half where the the hotels are at, they would be taxed at 6%.
Mm. So that's very similar, right? Because, like, if for instance, right, you go to CVS, they'll charge you the same amount of tax, but their prices are way higher than if you go to a local CVS here on, Summerlin. That is because how much does it cost to keep the area in the strip in business? You have to upcharge for the convenience because people are walking, people need water, it's a convenience store, right? They're not going to sell the product to you the same price that you can get it off the strip. Now that's not a tax, that's just, they just changed their prices. So it's $6.99 for a regular water bottle at CVS on the strip, where you can get that water bottle for $2.99 right here at the local store. Same CVS, but it's a different low area. So they can
Mm-hmm.
upcharge you, yes, but it's not a tax. That's the only difference you have to understand. It's not a tax because they're not, what is it? They're not they're not collecting or issuing an additional part of tax. Now, yes, it can be if for any reason that, for example, San Francisco, right? They have to be charged an additional local tax. Okay, so they have state, city, and local. Why? Because the local, right, this local tax is because they require to have a transportation system, as we all know, the famous train that goes through San Francisco. They need that to be maintenance. So that is something that they upcharge, not upcharge, but they have an additional charge to for people who live in San Francisco because they need to have that extra fee to go towards a public transportation. Okay, so I'm pretty sure New York has that extra upcharge for the underground subway system, but for any reason that needs to be something that needs to be implemented, that is going to be something that is going to be an example of what other taxes can be. But hospitality tax, it's not really heard of here, but I just know that the strip is very, very expensive compared to here, right? You go out to
Right.
the local, you just drive 5 minutes down out the street off the strip, and you can get everything for a lot significantly lower price, for sure. Okay. But for this class, since I don't want you to have to research where the tax that you are living in, I want you to just let's keep it sweet and simple and use 8.25%. Okay? Very straightforward, okay? It's a very simple, easy number to, round up. Okay? And it's a percentage of your total sales. Okay? So if you're selling a product, right, and it's $10.99, it's based on the selling price, not the number of items. So make sure you guys are aware of that. Okay, it is based on your total sales, the total amount. Okay. So let's go ahead and dive right in here. So again, example number one, or example here, June 1st, 10 items were sold and they were at $9.99. Each sales, of course, and sales tax is 8.25%. Record this sale. So what I'm going to introduce you is, well, we need to figure out what is the idea. So when we do a sale, right? If we're charging our customers $9.99 each, right? What is the assumption that we are going to be receiving? If we're going to have a sale, we're going to have some kind of cash, right? Some kind of money, whether they put it on a credit card, whether they charged it on their tab account and they choose to pay later, or they give you straight up cash. That is the first thing you're going to recognize. So in that case, we're going to be increasing our cash flow because, boom, we sold a product. The purpose is to get money from your customers. So in this case, that's the first thing you're going to recognize is you're going to have cash or some kind of form of payment. The second thing that you're going to recognize is going to be sales and sales tax payable. Now, sales. What kind of an account type is sales?
It's a contra account.
It's not a contra account. I'm talking about the account type.
Credit.
Not debit or credit, but the answer does get to there. What account type? Is it an asset? Is it a liability?
Oh, it's an asset.
Not sales.
Accounts payable?
No, not an account itself. I'm talking about account type. Is it an asset, liability, equity, revenue, or expense?
Revenue.
It's a revenue, right? It's our means to generate income, right? And we generate income through our sales. So therefore, since it's a revenue, its normal balance is a credit. So therefore, boom, I have my debit and I have my credit. Now the next thing is sales tax payable. What type of account is a sales tax payable? Is it an asset, liability, equity, revenue, or expense?
Expense.
No, it's not an expense. So in this case, when we did the chapter 2, there was a key word that I tell you that will indicate it's a... Okay. When you're collecting sales tax, is that your money?
No,
Whose money is it?
it's the state.
It's the state and the local agency. So in this case, if I'm collecting sales tax, Who do I owe?
You owe the state the
Exactly. So if you owe somebody money, what type of account is that?
oh, that's a liability.
It's a liability, right? So in this case, right? Now, let's just think of it in real life. You're selling a product to your customer. They're not going to hand you cash for the sales, and they're not going to hand you separate cash for the sales tax. This is your responsibility to make this separation so you know actually how much money is yours and how much money you owe the government. So this is one of the things that we have to do accounting for, is that just because you do a normal transaction, you sell a product to your customer, they give you cash, they're going to give you a lump sum cash, okay? And you're just going to shove it into the cash register. That is real life. On the other hand, for the accounting for the books, you need to journalize that yes, you received cash, but you need to make a separation that a portion of the cash belongs to you and the extra money that you charge on top of your sales belongs to the government. So that's why you have to have I'm introducing you to two sections, because in this case, you're collecting money that you purposely sold the product for, that is yours. And then you have to collect the money that you owe the government, because it is your responsibility, right? It was your agreement to the state and local agency, right? So whatever city that you are doing business in, because you are renting out a business building, or you bought a business building, because you are in that state and you are in that city, you have signed a contract to collect the sales tax. Okay. Now, yes, there's some um, rules and guidelines that you can what do you call it? Emit or omit sales tax, right? So again, for instance, food. Food is one of those special taxes that you do not charge sales tax for. You only charge sales tax on actual physical usable products. Now again, if you're a restaurant, completely different. Restaurant, you can charge sales tax. Right? Doesn't matter, because you're not selling a product. You're selling service at the same time as but also providing a product at the same time. Now, in this case, so restaurants have to charge sales tax, right? Now, other things too is you have to also know that certain items or certain items will be charged a higher tax than it is for regular sales tax. Okay, so that's going to be an additional one. So, for instance, alcohol. If you did not know, you buy alcohol from the grocery store, you're paying a higher tax because of the alcohol law, right? Same thing with tobacco. Tobacco, you're paying a higher tax because it's under the Tobacco Tax Act. Okay, so you have to know those are special taxes. Okay, there's many special taxes out there, and even if right you are an individual with for instance, right, if you're a U.S. Serve in the military army, you can take a discount, right? We know about the military discounts, right? So there are very many opportunities that you have to be aware of, especially when you sell a product to a specific customer, because some of the products can be charged a higher tax, some of the items can be non-taxable, and the individuals who buy your products can be taxed at a certain amount, or they can get a discount on that, okay? So you want to be aware of when you're selling a product, who you're selling a product to, and what kind of product you're selling to. Okay. Now, if you are selling alcohol, there is a rule and regulation of one, obtaining the alcohol. Two, you need an alcohol license, and you need one to be able to legally be able to sell the liquor, right? Because that is where you're talking to the government, right? And making sure that every dollar that you sell alcohol for is being taxed. Now, again, there's also other businesses who kind of do this under the table, right? Where if you pay me in cash, I won't charge you sales tax. That's because they're not going to record your sales at all. So in this case, right, yes, there are sometimes that is an option you can do, but it's definitely not recommended, just because if you're going to out yourself on a sale, right, even if it's one product, right, I won't charge you sales tax for you. Then again, that's illegal because we are mandated to charge sales tax on every single product except for, the things I listed above, right? So again, that is one kind of business that you can do if you're running a cash basis. Is yes, technically you don't have to charge sales tax. Okay, just a little FYI there. So in this case, right, if I sold my product, right, for $9.99 each and my sales tax is 8.25%, how much cash am I going to actually receive? Well, I won't know until I figure out what my numbers are. So in this case, I need to at least recognize that I'm going to be increasing my cash flow, right? Because I am selling a product. Then I'm going to recognize my sales. Well, what did I do? Well, I sold 10 items at $9.99 each. Therefore, that was a grand total of $99.90, right? 10 times $9.99 gives you $99.90. Now, again, the sales tax is going to be based off of the entire sales amount. So in this case, I'm going to have to figure out what the sales tax is, which is 8.25%, right? This class is only 8.25%, okay? Nothing more, nothing else, right? But again, if you are doing business somewhere else in the state, right, there are a total of 5 states that do not charge sales tax. Unfortunately, we are not the ones in it. So make sure that you are aware that every state and every city is going to have a different tax. Okay. So in this case, we know that it's going to be 8.25%. So you're going to do 8.25%, right? We're doing simple math here. So because it's a percentage, right? How do you convert a percentage into decimal? So you just move the decimal place to the left. So in this case, you're going to be multiplying 9990 times 0.0825, and that should give you your total amount of tax. Now in this case, it's close to $100, so it should be roughly $8.24. Then once you get that, this is where you can go ahead and understand how much total is your sales. Okay, so you're going to be charging a grand total of $108.14. Okay, now do not confuse this because some people do get confused on this concept. If you are the person who's in charge of the cash register drawer, if someone gives you okay? If someone gives you $110, that doesn't mean you take the full $110. Why? Because you're giving them the $1.86 back. So you're exactly collecting the 108.14. Okay? Understand that. Now, if they say keep the change, what do you do with it? You got to put it into some kind of tip drawer so then you can count that money. And we'll talk about bank reconciliations and dealing with cash registers in chapter 10. Now, in that case, right, you have to be aware, because if a customer gives you cash and you're giving them money back for the change, you are only collecting the exact amount that you're charging for. Okay? So again, make sure that you are aware of this idea. Okay? So when you are selling a product, you must do 2 things. Separate the amount of money that you actually earned, and then you're going to separate the money that you owe to the government. Okay? All right? This is the accountant's job, to make a separation between the two, while whoever's running the floor in your store, their job isn't to do anything except for tend to the customers, give them their change, and that's it, and collect the receipts. Okay, so that's why it's important that you collect receipts, especially when you do a sale, because this is what you mean. This is what it means to keep track of every sale by looking at the receipt and determining how much money that we've collected and how much sales tax we've collected. Okay, any questions? Any questions? Norman?
No questions.
Okay, I was making sure that you knew that your microphone is on. All right, so no questions? Okay. Well, that is all that you need to know, because under the periodic inventory, right, we do not recognize sales, okay, until the end of the period. Okay, so remember, right? What was so special about periodic inventory? We never kept track of how many items we sold. How did we figure out how many items we sold? Someone had to go down to the basement, take a physical account, and let you know, well, if you started with X amount of items and you only have this amount on hand, your assumption is you must have sold X amount of items. Right? Not the best way to keep track of your inventory, because again, what if someone came in and stole your items? What if someone decided to take it because they were an employee and they say, oh, well, I'm an employee, so I can take whatever I want, right? Or maybe you gift it. There are many reasons why that's not a very good method to keep track of your inventory, but there is a reason behind it. It's because this one you don't really care to keep a really good track record of it, because maybe it's something that you don't really necessarily sell often. Or if you're going to buy a huge batch of it, right? Let's say you buy 1,000 of them and every day you're only selling one or two. Great. Then when will you eventually sell off 1,000 items if you're only selling one or two items per day? Right? So in this case, right, the idea of using periodic inventory, it's not necessarily to again um, to buy a product and then just you know throw it around, or don't keep track of it. But again, with technologies these days, it's more or less where even if you're on a periodic inventory, you still have some kind of way to be able to keep track of the inventory, but you don't actually have to do a physical count all the time. Okay, so again, that's the beauty of technology. There are many systems that can be able to keep track of the inventory for you without you having to do anything. Okay. So again, that's what periodic inventory does, because again, we have to wait till the very end of the accounting period to go ahead and be able to figure out how many items that we sold. Okay. So no questions. That is done with chapter 6 point section 1. Okay. So of course, when we are introduced to sales returns and allowances, right? So again, if you can sell a product, you have to also keep in mind that you will eventually have those customers who want to return the product. Okay? So this is where I'm going to introduce you to sales returns and allowances. Now, of course, when we sell a product to our customers, right, we are trying to ensure that the product is being sold, okay? We want to ensure that the customers like the product that they are purchasing, right? That's the ultimate goal, right? Is to get customer satisfaction with the product that you're selling, okay? Now, of course, there are many, many reasons that a customer can choose to return the product, right? It could be broken and defective. Again, maybe they don't want it anymore, and it could be that they're just completely unsatisfied. They use the product, they determine that this is not the greatest product that they purchased, so they want a refund, or they just want to return the product and get rid of it, right? Oftentimes when you get presents from individuals, right, It might not be something that you like or something that you want. So oftentimes they'll give you a gift receipt and you can go and exchange it or get something else out of it. So that is going to be something that, again, our main goal is to sell a product to guarantee customer satisfaction. Now, with this in mind, if you know that there are people out there who are going to try to return the product just because, there is something that you need to keep in mind. You need to set some kind of parameters to restrict your customers from coming into the store and buying all the products that they want to buy and having the capabilities for them to return it at any given time that they want, right? So we have to create some kind of company policy. Why? Because the goal is we need to keep the products sold, okay? We can't, if you are so in tune that your product is guaranteed the best product out there, and you're going to allow all of your customers to want to return whenever they want because, again, they believe that this product is such a great product, but the customer themselves doesn't want it. There are people who are out there who do this, where they buy a product, use it, go back, complain about it, get their money back, and buy something else with it. Yes, unfortunately, there are people who are like that. So that's why it is very, very important to create some kind of company policy to prevent that, because the goal is to keep the product sold. Okay? So what are those examples? So for example, right, having some kind of time frame. So again, you can issue a full refund within X amount of days. So for example, you could do 15 days, 30 days. So again, companies like QVC, I believe they go for the maximum of 90 days full refund. You can use the product to the point where you don't have anything left. And if you're completely unsatisfied with that product, you are able to return it within 90 days and get a full refund. Okay? So, again, you want to be very careful of what kind of company policy that will fit for you, because, again, if you do have those individuals who buy, use, and return, and just get money out of you 24/7, then that's going to be a problem. Okay? Other things, right? For example, you can say, no, this is final sale only. So therefore, you buy the product, you can't return it. Okay? Other things too is store credit. So for instance, they purchase a product from you and you say, no, I'm sorry, I cannot give you your money back, but I can offer you store credit. So what are you doing there? You're letting the customer continue and only continue to shop in your specific store because you get them a store credit. So therefore, you guarantee that sale no matter whether they buy the product or not. Okay? And then other ones could be issue you a new product. So for instance, if it's a damaged good, sometimes I know Amazon used to do this, where you can complain that you have a broken product. They don't require you to ship it out, and they give you a new one for free. All right. So again, a lot of these company policies is in tune with 100% customer satisfaction. Okay. And of course, you could do full exchanges for full prices. So again, if the person doesn't like this product, you can do a full exchange for the actual value of the item. So you're trading an item for another item. Okay? So again, our goal is to keep 100% customer satisfaction. So in this case, we just make sure you have those parameters to keep customers from not returning the product all the time. Okay. Now, of course, if you're going to be returning the product, you have to keep this in mind. You have to give back the sales tax money. Why? It does not belong to you. It belongs to the government. And if the individual, this is their responsibility for paying into the government, okay, through sales tax. So if they're returning a product, you have to give them their money back that they paid for the portion of contributing to society. So that's going to be, again, it's not part of your money. It's just money that you owe, so that you're going to owe significantly less because they returned the product. Okay? So let's keep that in mind. So for instance, right, let's go ahead and let's purchase the product first. Okay? So in this case, on May 1st, okay, you sold 50 coffee mugs for $5 each. Sales tax is 8.25%. Okay? And of course, a customer pays with cash. Okay? For the mugs. So record this transaction. So again, what did we receive? What did we receive from this?
Revenue.
Okay, we earned revenue, but what did we receive? What's the first thing that we got out of this transaction?
We got 50 coffee mugs.
We didn't get 50 coffee mugs. We didn't buy.
Oh, we sold it.
We sold it, okay? But what did you receive on the other hand? What did you get out of this sale?
We got cash.
You got cash, right? That's the first thing you have to do, okay? So the first thing is we need to recognize what is the transaction at hand. Well, in this case, you sold a product. What did you get out of it? I got cash, okay? So boom. You got cash, you sold a product, you have to charge sales tax, okay? So now let's go ahead and determine what those values are. So again, if you sold 50 coffee mugs for $5 each, how much is that in total sales?
Okay, it's $250.
$250 for the sale, just the sale. And then you, on top of that, you need to calculate how much tax you collected on top of that. So in this case, 250 is your total sales. You need to multiply it by 0.0825 to get the tax, and you're going to get $20.63 worth of tax. So at the end of the day, you received a lump sum of $270.63 worth of cash. Right? That's what you have to recognize, right? What did you do? What is the main transaction at hand? You sold coffee mugs, and you got some kind of form of payment out of it. Okay? So now, right, let's say it's now fast forward, it's now May 10, and this customer, okay, wants to return 10 coffee mugs for a full refund, okay? And of course, your company's return policy was a full refund within 15 days. So in this case, right, if we sold it to them on May 1st and it's only 10 days, they fell within the company policy. So therefore, you must issue them their refund, okay? So what are we going to be doing here? Well, in this case, sales is definite, meaning once you earn your sales, you can never unearn it, okay? So think of it that way. If you recorded that you've earned your sales, you can never undo it. So then how in the world do I issue a refund? You're going to have to create a contra account called sales returns and allowances, right? Now, sales returns is straightforward, and allowances, we'll talk about what allowances does. The reason why I combine these two is because they are more or less the same idea. The only difference is one of them is a full refund, and an allowance is just a portion of the money back, right? Okay, but they do the same thing. They're returning the item, or they're returning a portion of the money back. Okay? It's still a refund regardless. Okay? So in this case, right, we have to create a contra account called sales returns and allowances. So for instance, right, if you ever gone to a store or a mall, for instance, right, you purchase a product and then you go and return it, right? If you ever looked at your receipt, you're going to see the same exact thing. You're going to see what they originally charged you. Right below it's going to be a negative number. That right there is going to be your sales returns and allowances. And then below it gives you the tax number or the tax amount that they have to give you. And then at the very bottom of the receipt is the actual cash that they're actually giving you back. Okay? So this is something that you have to know. It's for all types of businesses. There's no such thing where you can take it out directly from sales, right? Because once you earn it, you can't undo that. Okay? So how do you reduce your sales? You create a contra account, and we call this sales returns and allowances. Now, if you remember the rules, right? If it's a contra account, it flows in the opposite direction. So if we know that sales is a revenue and it's normally increased by a credit, well, there you go. You're going to put it in the opposite direction. This comes first because sales returns and allowances is a contra account. So you're going to be debiting this account. And again, this is a contra account that reduces your sales. Okay? So again, it's directly correlated to your sales, but in this case, this is your refund. Okay? Now that I have my sales returns and allowances, right, I also have to give a portion of the sales tax money back. Right? We talked about this. If you sold a product and charged tax, you need to give the portion of the money back for the tax. Okay? Based on the total amount of sales that is being returned. Okay? And of course, however the customer paid, so in this case, customer A paid us with cash, you're going to give them back cash. If they paid with a credit card, you give them a refund to the credit card. If they paid you on an account, then you just reduce their account. But whatever kind of method that they paid you in, you have to give it back to them in that way, unless the customer specifies. Okay? So for instance, you go to Target and they say, here's $10.50. You could tell them, put it on a store credit. I'm gonna buy something else with it. Then they can easily give you the refund via store credit. So instead of giving you your money back for you to buy anything else besides in Target, you tell them that you want to use that money for Target. So therefore, yes, it's based on what the customer also wants as well. But one thing that you cannot do and should not do, if they charge on their credit card, you should never, ever give them cash for the refund. For this kind of case, that is not the best way to do it, because if they charge on their credit card, a credit card is a liability to them and they're getting cash out of it, no. That's not how it works. It has to go back to their card. But if they paid in cash, they get their money back for sure. Okay? So that's just a little fun fact there. So in this case, we know that customer A has paid with cash, so that's what we're going to be giving back. So now we need to determine what was the actual return. Well, let's think about it. If customer A wants to return 10 of those coffee mugs, right? How much did we originally charge the coffee mugs at? $9.99. So therefore, you need to calculate it. 10 times $9.99 is going to get, or sorry, we charge $5, excuse me. We're talking about coffee mugs here. We charge $5 for the coffee mugs. Since the customer is returning 10 of them, 10 times 5 is 50. Then you're going to have to figure out how much sales tax is off of the $50, right? Not the quantity. $50. Therefore, it's going to be, right, multiplied by 8.25%, which is going to give you $4.13. So you always round up for tax because it's going to give you 4.125. So you're going to round up for tax always. Okay? So in this case, you're going to be giving the customer $54.13. Okay? Straightforward. Any questions? Okay, no questions. All right. So let's talk about the difference between returns and allowances. Okay? So for instance, on May 18, customer A wants to return 10 of those coffee mugs, okay? Separate scenario. And they want a full refund. But of course, they missed the company policy because, again, it was a full refund, okay, if they return it within 15 days. They missed it. And it's because they're complaining that they don't like the color. Or, they thought they liked the color, now they don't like the color. Okay? And of course, you sold it to the customer and they have missed the return policy period. Okay? And they are willing to accept, or in this case, you're willing to give them a 15% additional discount. Okay? Why is that? Now, in this case, what if this customer was complaining about everything in the store, right? We all know that there are some individuals who are like that, where they come into the store and they're not getting what they want from the store. They start complaining and start making a commotion and so on and so forth. So because you don't want to be rude or anything like that, and you want to provide the best customer satisfaction, once again, customer service, there is where you can have the ability to give a additional discount on the product, okay? Now again, for corporations, no. If a customer comes in and complains about something, you give them 100% their money back, because that gets them out of the door a lot quicker, okay? That doesn't cause anything else. Now, for a small business, you have the capabilities to haggle prices with your customers, okay? So again, if you sell a product at $9.99 and the person's like, no, can you charge $7.99? You can haggle with the prices with them, because again, you're a small business. You're trying to get any penny out of a customer, but at the same time, they're trying to get every penny out of you. So in this case, if for any reason that you have those individuals who are complaining about your small business and throwing commotion that they missed out the discount and that they're completely unsatisfied with the product that they have, you could tell them to keep the product and say, how about this? I'll give you a discount. On top of that, I'll give you a coupon, so when you come back, you can take a discount. Whatever it is that you are offering to them, you are allowed to do as a small business owner. Okay? For corporations, again, not so much. So in this case, right, how do you issue a allowance? Now, in this case, again, it falls under the same category because they're not returning the product per se. You're allowing them to keep the product, but you're giving them a portion of the refund back to them. Okay? So do not confuse this discount with an actual discount. Okay? Huge difference between an allowance discount versus an actual discount is, for an allowance, it's based on the individual. You don't give it to everybody. Where an actual discount, you give it to everybody. Every individual, every customer that goes in your store gets the same discount. This one is because they are trying to return the product. They're setting commotions. They're frustrated. They are completely unsatisfied with your product. They're complaining. So you go ahead and give them the additional discount. Okay? So here you do a sales returns and allowance. Okay? Now in this case, they're still trying to return those 10 coffee mugs for a full refund, but you say no. Okay, so how are you going to distribute this 15% discount? Well, in this case, you're going to be recognizing, again, that you have a sales returns and allowances. Because it's a portion of the money back, you're going to also give them their tax money back. And you're going to give them whatever form of payment that they paid. So in this case, you're going to calculate first. Well, how much are they actually trying to refund? They're trying to refund 10 coffee mugs, right? We charge them $5 each. So therefore, the total amount is $50. But because I'm not giving them a full refund, I'm only giving them 15% of their money back, then you just go ahead and simply multiply across. 50 times 15% is going to give you a total of $7.50. Now again, a customer will take every penny that you offer. So if they cannot get a better discount, they will say, fine, I'll take the 15% discount. Then everything's square and you're ready to go through with it. Okay? So there you go. You got $7.50. Now remember, sales tax is based on the total sales, not the quantity. Even though they didn't return the product back to me, I still sold to them $50 worth of materials, but I'm giving back to them $7.50. So my discount is going to be based on that $7.50. So you go ahead and multiply across with the 8.25%, and you're going to get 62 cents. So you're going to give them a grand total of $8.12 back. Okay? Any questions here on regards to allowances?
No.
Okay. Right? You sure no questions? Anybody? No questions, right? Right? So now we have section 6.3. So again, we're done with returns and allowances. So now, of course, with sales, you're going to have discounts. Okay? So again, what is a sales discount? Well, a sales discount basically is some kind of method that entices your customers to come into your store and buy your product. Okay? Because we understand that the nature of a business is to once again to gain a profit, right? But you also have to understand is customers, right? If you understand supply and demand, the customers have to be willing to pay the price for those items. Now again, if the product is that great, customers will pay full price for it. But if they can go ahead and get that same exact product and it's significantly lesser, they're going to buy the item that is significantly cheaper because their dollar can stretch and buy multiple items instead of just spending it all on that one item, right? That's the idea, is that we also have to take into consideration that our consumers also want to get the best bang for their buck. So in this case, that is exactly why oftentimes many stores that sell goods and services, products and services in general, right? You're going to notice that not all the time is someone going to pay something for full price. So how do you entice your customers to come in and buy your product? You have a sale, okay? Because if you have a sale and you let everybody know about it through marketing, advertising, sending weekly newsletters, some kind of way to be able to reach those customers, right? And they know that you're having these specific products on sale. They're going to go ahead and say, yes, I'm going to buy this price because it is half off. Or it's a buy one, get one half off deal. That is way better. I can buy the product for one price and get one free or half off. So in this case, this is how you make your sales, is you do have some kind of sales. So some sales. So again, an example could be a grand opening sales, right? How do you get new customers to come to your store? Offer and grand opening sales, right? Let them try your product at a low price. Okay. Other things could be, weekly sales. So again, grocery stores, right? You may be eyeing that coffee for, a long time, and then all of a sudden they give you a weekly ad saying, guess what? Coffee is on sale. You're going to go and buy it. And you're not going to buy one. You're going to buy maybe 2 or 3 or even 5 because it's on sale. And usually these products never go on sale. So if that's your justification, great. So that's exactly what I mean, is that that's how you entice customers to come to your store, is by marketing yourself and having a sales. Now, do not get this confused. When you are doing a sales discount, you are not discounting the cost of the product. You've already incurred the cost of that product. You're only taking a discount off of the profit. Okay, so if you remember talking about the profit percentage, right? There's the price of the product is going to include how much it cost you, and how much money you want to earn on top of that. So this sales discount is going to only reduce the amount of profit that you are earning. Now, again, even if the profit is $2 more, that's still $2 that's in your pocket. You never want to dip below your cost point, okay? Because then you make zero profit out of it, and that's not the point of selling products, okay? Because then you're gonna out yourself in that kind of situation, okay? So you're only discounting your profit percentage, your profit margin. Now, again, there are companies out there that buy products at $1 and sell it for $5. So again, they have a lot of leeway room. That's almost a 500% profit right there. They're gaining, no, it would be 400%, excuse me. Why? Because they're gaining $4 when it cost them $1 to purchase it. So think about it. That's a $400% profit. Now imagine this. If they're trying to do a discount, they say, well, I'll sell my product half price. So it's now $2.50. They still will profit $1.50 out of you. So that's the idea of a sales discount, is you're only discounting the profit amount, right? Not dipping in to the point where you end up taking a loss. Okay? So again, we can have a couple discounts, right? You can have an in-store discount, or you can actually give individuals who, for example, open up accounts, you can give them special discounts as well. Okay. So let's talk about how sales discounts work when you are in the store, okay? So again, let's go ahead and take a look at this example where on June 1st, your store is having a promotional sale where all items are 40% off. And of course, a customer buys 10 baseball hats, which each were originally priced at $10 each, okay? And of course, sales is 8.25%, and of course, you're going to record this transaction. So in this case, right, if every single hat is priced at originally $10 each, and you're offering that the whole entire store is having a 40% off discount, okay? How much money are you going to be actually charging your customer? Well, let's go ahead and figure it out. Now, this is what your journal will look like. Yes, sales discount is another contra account once again, okay? Because in this case, we've already talked about it. When you earn your sales, it's definite, meaning if you earn it, you cannot unearn it. Now, in this case, you're trying to reduce your sales by giving a discount, right? We talked about what this discount does. It takes away from your profit. So therefore, how do you record this? We're going to create a contra account called sales discount, okay? So again, if you ever gone to the store and you bought something on sale and you look at your receipt, you're going to see if they charge you at full price, the line underneath it will be your discount, and it will tell you how much the product is being discounted at. And then you'll get your subtotal at the very end. So yes, even at a regular grocery store, a sales discount is always a separate line. Okay? They charge you full price, then the line underneath it is going to be subtracting out your discount and subtracting the amount that the discount is for, and then they charge you full price. And then they charge you whatever the amount is. Okay? So for instance, now that we know that we sold 10 hats at $10 each, right? That means my total sales was $100, okay? I have to recognize what the total sales is, which in this case, the total original price. So in this case, my total sales is $100, okay? And we know that our discount is 40%. So what is 40% of $100? That's a $40 discount. So therefore, you're going to put the $40 right here on your sales discount. Okay. Now, of course, if you read a receipt, it's going to be sales, sales discount, subtotal, tax, total, right? So in this case, so that's exactly how you're going to calculate this as well. We got the total amount, we got the full price. We're going to subtract the discount, which will give you $60 left. And with that $60 is the actual amount that you can charge tax at. You cannot charge tax for the $100 because you didn't sell $100. You took a discount. Again, it's based on the sales price. In this case, I took a discount. That means I can only charge up to $60 worth of tax. So that's what you have to understand. So sales tax, again, second thing too, you cannot tax a discount, right? So that's why usually when you have a sales discount, tax is always after the discount, okay? So there you go. There you go. Now you got $60. You're going to multiply the tax to get $4.95. So therefore, you should be collecting $64.95 cash. Okay. Any questions?
No.
Okay. So then let's talk about other discounts that you can give to your customers. So for instance, right, anybody that usually opens up some kind of store credit card or some kind of account, right? So oftentimes when you open up a credit card, right, the very first thing that they're going to give you here is, hey, if you open up a store credit card, we can give you a 20% discount. Okay? Why? Because you're opening a store credit card with them. Okay? Other credit card companies, right, their way of giving you a discount is, hey, we will defer the interest payment, right, for a whole year for you. That's their discount to you. Okay? So in this case, there are many ways that a lot of companies entice their customers to try to open up an account with them or try to get the best deal for them, right? If they're buying a lot of items, they can say, hey, take advantage of this. We will allow you to open up a credit card so you can continue to buy our products and you can pay later. You don't have to pay at time of service. Again, credit card companies is a trap, okay? Because they're trying to get your money through interest. Okay? But just a little fun fact here, if you are planning to offer your customers who do open up an account for you, you can give them a discount if you want to. But there are other discount opportunities that you can also offer as well, and that's through terms. Okay? So we did go over terms before, right, for purchases, right? Terms is where we can offer a customer to take advantage of a discount opportunity if they pay within a certain amount of time. So in this case, right, for this example here, is that a person wants to open up an account and we offer this discount opportunity, but they have to pay us back within a certain amount of time frame, right? This is an incentive to give your customers so they can pay you back, right? Because again, if you're going to allow them to owe you money, you don't want to allow them to extend the payment to you over a long period of time. You want them to rush and give them your payment as soon as possible because, again, you need the money in order for you to continue your operations of your business, to buy for more merchandise, to pay for rent, to pay your employees. You need the money. So therefore, that's why you create these terms. So terms can be applied for both vendor and customer. Okay? So in this case, on July 1st, a customer wants to buy in bulk, okay, 100 baseball hats from your store, okay, on an account. Okay, and because this customer is a first-time buyer, okay, you offer them terms of which it's going to be a 5% discount opportunity if they pay within 15 days. If not, then they have to pay in full within 30, okay? And of course, each baseball hat is going to be sold for $10 each. Sales tax is 8.25%. And an additional delivery charge is $10. Okay, so let's go ahead and record this transaction. Okay, so here's also one thing that we also need to know too is that we are now introducing to allowing our customers to pay on an account. So therefore, we're going to have an accounts receivable, right? We are charging our customers for what they owe me, okay? Now, an accounts receivable is not a liability, okay? An accounts receivable is an asset because in this case, right, we are not owing my customers anything, right? So that's why it's not a liability because a liability means that we owe somebody, right? Whether it's a customer, vendor, or whoever, employee. That's when we owe somebody. The company owes. But in this case, the customer owes the company. Now, in this case, what we recognize it acts as if this is cash that we have, right? This is a customer writing us an IOU saying they're giving me a voucher saying that they're going to pay me X amount of dollars. So therefore, that's going to hold, again, invisible money value to say that I earned my sales by getting a voucher for X amount of dollars and eventually my customer will pay me back. Okay? So that's an accounts receivable. It's cash and I can collect it from my customers within 24 hours. I just bill them. Right? I bill them and say that your due date's tomorrow. Okay? I call them up and say, "Hey, you need to pay your credits, your store credit payment. You need to pay your account." You can collect the money instantly. Right? Now, of course, we're going to also recognize sales tax, and of course, we're going to do delivery charges. Now, once again, why am I not putting my discount in here? Terms is a condition that must be met. So the idea is they have to pay you within 15 days in order for them to get the discount. So again, terms is a condition. A condition must be met in order for you to apply a discount. Now again, in this case, that is exactly why we do not write the discount right away. All right. So here we sold 100 hats at $10 each. So that's 1,000. We charge the tax based on the 1,000 hats. So that's going to be 8.25%, which gives you $82.50. And because this stage we had to give an extra delivery charge to ship out a bunch of hats to this individual customer, we're gonna charge them $10 for it. Right? So there you go. Now they owe me $10.92.50. Okay? So then, right, let's say now it's fast forward, it's July 12th. Okay, so we sold the product to them on July 1st. It is now July 12th, and now the customer decides to pay us for their purchases, okay, in full. Okay, so let's go ahead and record this transaction. Don't forget the terms is 5% discount if they pay within 15 days. If not, they have to pay in full in 30. So in this case, did they meet my discount due date?
Yes.
Yes, right? We gave them 15 days. So if we sold it to them on July 15, 15 days later it's going to be July 16. Okay? So therefore they paid within the discount due date. Okay? So what am I going to recognize here? Well, since they're paying me, right? We're going to receive some kind of cash or some kind of payment. Okay? Second thing that we're going to do is because they made the discount due date, we have to recognize that they are going to get a sales discount. Okay? And because they're going to get a sales discount, we also have to give a portion of the money back for tax because when we originally charged them on their account, we charged them full price for the product that we sold to them. Now that they're getting a discount, we have to undo that tax. Okay? And of course, they're paying off for what they owe me. So in this case, this is what we have to recognize. What was the total amount that they owed me? In this case, they owed me $1092.50. So that's the first thing I'm going to recognize is $1092.50. Okay? Then I'm going to go ahead and recognize, well, how much is the sales discount? Now in this case, I can only take a discount off the selling price. So in this case, how much did I originally charge my customer? I charged him $1,000. I cannot discount the entire $1092.50. Why? First off, you can never discount sales tax. That is illegal, right? Because it's not your money, it's the government's money. So you cannot discount the money that the customer is responsible to pay for society. Second of all, too, is you can never discount delivery charges because this was a separate charge to the account. This person could have literally walked into the store and walked away with all 100 hats, but because we were like, hey, instead of you having to carry all these boxes of hats, how about we do we just deliver to you what you want? $10 charge. Or maybe we didn't have it in stock, so we'll deliver it for you. You cannot discount delivery charges. So therefore, what can you charge? You can only charge for the actual sales price. So in this case, I can only take the discount off of the $1,000 that I charged. Okay? So therefore, 1,000 times that 5% is going to give you $50. Okay? And again, because I'm reducing the price by $50, I also need to give back a portion of that sales tax money back. So in this case, I'm going to take the $50 and calculate how much sales tax I'm going to be given back. Okay? And therefore, it's going to be $4.13. So therefore, the cash payment that I'm going to be receiving from this customer is going to be $1038.37. Not $1092.50, right? Because we gave them a discount. So we are going to be receiving significantly less. Okay. All right. Any questions in regards to sales discount when we give terms?
No.
Right. So here's the course review, right? We talked about what a sales is, right? So we sold items, right? If you have charged sales tax, then you charge sales tax. If not, you don't have to. Okay. So there you go. You got sales. Of course, we talked about sales returns and allowances, where if a customer decides to return a product to you back, you issue them a full refund. You're going to give them sales returns and allowances and however form of kind of payment that they paid you in. If they decide to miss the discount due date or anything like that and you are giving them an allowance, you're still going to recognize sales returns and allowance and it's going to be a portion of the money back. Okay. Other things that too here is that you are, again, if you're going to be charging sales tax, that means sales tax must be included in the refund. Okay. Then we talked about sales discount, right? We talked about what happens when you charge in store, okay, versus giving individuals terms, okay? So again, there's your two options, that right? We gave an example here that when you are charging in store, you're going to be recognizing the sales discount and you're going to be charging the tax based on the discounted price, okay? And of course, for this one, when you are charging on an account, you're going to recognize everything at full price, and it's a condition that must be met. So if they meet the condition, then you're going to discount, and of course, you're going to include the tax as well. Okay, so yes, right. But then again, yes, and if they paid and they missed it, then they just pay for what they owe. So again, sales tax and delivery charges cannot be discounted, right? So other than that, any questions for the first part of 6.1, 6.2, 6.3. Okay, so let's go ahead and spend the next half an hour or whatever it is, right? Next couple minutes here to go ahead and go through the exercise, and I'll let you guys go. Okay. Number 1. Okay, we're gonna journalize and assume sales tax is 8.25%. So here on April 5th, you sold 100 cups at $5 each. Okay, to customer A for cash. Okay, so how are you going to journalize this transaction? So again, April 5th, you sold 100 cups at $5 each on, to customer A for cash.
So description would be cash.
Cash, right? Because that's what you're receiving. What else?
Sales tax payable.
Sales and sales tax payable. Okay, good. Okay, so let's go ahead and do some math. Okay, first we're going to recognize how much we're going to be actually charging our customers. So 100 cups at $5 each. How much is my total sales?
That's 500.
$500. Okay, now let's calculate how much tax we have to charge on top of that $500.
It would be $4.12, 13 cents.
Move the decimal place one more. So in this case, it's $41.25.
Yeah, 41.25.
Okay, good. So therefore, how much cash am I going to be collecting from customer A?
541.25.
Good. So therefore, my description is going to say sold 100 cups to customer A. Okay, you don't need to write cash because it's already straightforward that you use the cash account. Okay? But the idea here is now you sold to customer A. April 7, you end up selling 25 cups at $5 each to customer B on an account, and you gave customer B terms of a 10% discount opportunity if he pays within 15 days. If not, the whole entire amount is due in 30 days. Okay? So, how do we record that we sold 25 cups to customer B on an account?
So accounts receivable.
Accounts receivable.
Sales.
Sales.
Sales tax payable.
Okay, good. So if I sold 25 cups at $5 each, my total sales is
$125.
$125. Okay. How much tax am I going to charge on $125?
$10.32.
$10.32. Okay. So therefore, overall, how much does customer B owe me?
$135.31.
Is it 31 or 32 cents?
32.
32. In this case, right, that sales tax is 10.3125. So you don't round up for this one. You round down. Okay? So in this case, it's 31. Okay? So again, we can go ahead and say that we sold 25 cups to customer B. Okay? And we gave customer B a 10% opportunity if he pays within 15 days. If not, it's due in 30. So you can even include the terms on here. Okay? So then April 10 rolls around and you sold 50 cups at $5 each to customer C for cash. Okay? So on April 10, you sold 50 cups at $5 each to customer C for cash. So how do I journalize that?
Okay, you will do cash,
Mm-hmm.
sales,
Mm-hmm.
sales tax payable,
Mm-hmm. Okay, so I'm going to copy and paste here because this is the exact same transaction. Okay, for April 10. But this time my numbers are different. I sold 50 cups at $5 each to customer C for cash.
okay, that's $250.
Okay, so $250. So right, 50 times 5 is 250. How much sales tax?
$20.63.
Okay, giving me a grand total of
276.63.
yes, 270.63. Good. Okay. So then on April 15, customer A decides to return 10 cups for a full refund. Okay, so we have to issue customer a full refund for 10 cups. So in this case, let's first figure out, how did customer A pay me?
Cash,
They paid me with cash, so I'm going to refund her with cash. Okay? So, how do I refund her the cash?
accounts receivable,
Sales
No.
returns and expenses.
Sales returns and allowances. Okay, good. Sales returns and
Sales,
allowances.
sales tax payable and cash.
yeah.
Right? Because we have to give them a portion of their money back for the tax. And because they paid with cash, we give them back cash. Okay? So, if customer A decides to return 10 of those cups, how much did we charge each cup?
$5.
$5. So in this case, how much money are we actually giving back to them? Well, let's figure out how much is the total sales that we're returning.
$50.
$50, right? 5 times 10, $50. Now, how much tax are we going to be giving back?
$4.12.
$4 and 12. It should be 12 and a half. So it should be 13. Okay. So we are going to be giving them $54.13. Okay. Now, let's take a side note real quick because we're thinking, well, how is this sales tax money $4.13? Well, let's take a look. Okay. We'll do an example here on the side over here at the bottom. Okay. Let's see. What was it again? We sold to them 100, right? If this is, let's say this is potentially your receipt, right? You have your sales, which was 100 cups, right? At $5 each. So your total sales is going to be $500. So let me go ahead and just do an example here. So this is your sales receipt. So here's your total sales is $500, right? Then you get taxed. Or in this case, yeah, you get taxed, right? Which is the 8.25%. So in this case, it's going to be so that's going to be what? $41.25. So then you're going to get your total, okay, to be $541.25. Now let's say I am returning the product, right? I'm returning 10 of those cups. So therefore, if I were looking at how many actual items I sold, right? I sold a grand total of how much? Well, if I sold originally 100 cups and they are refunding me 10 of them, then I sold 90. So 90 times 5 is going to be $450. How much tax is charged on that?
$37.13.
$37.13. Thank you. Okay, and then so then in grand total they're going to be charged was that 4, 8, 7, 13. Now let's go ahead and look at the difference between these two. The difference between these two is $50. And what's the difference between the taxes? It should be roughly $4. In this case, it's 12 here, but it should be 13 because tax usually goes up. And then that's where we solve for this difference between the two. Okay? If they're returning 50 of those $50 worth of products, right? That's how we get the sales tax money that we're returning. Is that it's just the difference between the two. You're not recalculating how much that they are using on their original receipt. We're just taking the amount that they're gonna get refunded for, and just taking the sales tax right off of that. Okay, so that's how it works. Okay, so just in case you're confused of where the sales tax money is coming back from when they are doing a refund. Okay, so there you go. And we decided to give them cash. So again, customer A returns 10 cups for full refund. Okay. So then on April 20th, customer C decides to return 25 cups but is willing to accept a 15% discount. Okay, so in this case, maybe they missed the return policy date and they're willing to take and accept a 15% discount. So how do we issue an allowance?
Sales return and allowance.
Right, it's the same account because in this case they both function the same exact way. So that's why it's sales returns and sales and allowances, okay? Now, in any company, right, they can't have a separate one for returns and a separate one for allowances. But in this case, they function the same exact way, so I just treat them as the same thing, right? What else are we also going to return?
Sales tax payable.
Yep, we have to give them a portion of the money back, even though they didn't return the product to me. And how did customer C pay me?
Cash.
They paid me with cash, so I'm going to refund them in cash. Okay. So in this case, I am refunding, right? They want 25 of those cups to be returned, but in this time they don't want a full refund. They are willing to accept a 15% discount. Or in this case, we can't give them a full refund. We can only offer them a 15% discount. So how do I figure out this total amount here? Well, first I need to know how much the grand total amount is for the refund. Okay? So in this case, 25 of those cups, what was my original price that I charged them at? $5 each. So 5 times 25 gives you
125.
125. And because I'm not giving them a full refund, I'm only giving them 15% back. So therefore,
18,
yes.
1875.
Sorry, where am I? Here, 1875.
Yes.
So then how much tax am I going to also be giving back?
So you would subtract the 125 and the 18, right?
One,
And then do sales tax off of that.
no, the sales tax is just based off of the 1875.
Okay.
Mm-hmm.
$1.55.
Okay, $1.55. So therefore, grand total that I'm giving back $20.30.
$20.30.
There you go. Okay, and then now I'm going to go ahead and make a note here. So remember, sales tax is not based on the product that we're selling. It's based on the total amount of sales that we're actually initiating. Now, in this case, we're basically giving a discount on the product. So therefore, we're also going to give the tax money back because we charged them for full price. Okay, so in this case, customer C returns 25 cups for a 15% discount. Okay, or you could say customer C gets an allowance, okay, on 25 cups for 15% discount. Whatever that makes sense to you. Okay? last but not least, right? April 22nd, customer B decides to pay in full for his purchases and makes the discount. So therefore, let's take a look. We gave them and offered them a 10% discount if they paid within 15 days. If not, it's due in 30. We sold to customer B on an account on April 7th. How many days does he have to make the payment?
15.
15. So let's count. If it's April 7, what date is 15 days from now?
27th. The 2nd.
Second. Yes, good. So in this case, he barely made the discount due date. He paid on the very last day of the discount due date. So therefore, he did make the discount. So therefore, we need to give him a 10% discount, and he's paying for his purchases. So assume he's paying with cash, right? Or paying with a check, whichever one that you think is best. So in this case, let's do either or. Okay, so today's the 22nd. So he paid me using a check or cash, whichever one. What do we need to recognize?
Sales discount.
We have to recognize that we're giving him a sales discount.
Sales and sales tax payable.
Okay, we already charged him for the sales. We already sold the product to him. So there's no need for another sales and sales tax payable. However, we do need to give something else back to them. Because when we charge them on an account, what did we charge at full price? We charge sales tax at full price, right? So in this case, we do actually have to use sales tax, but in this case, we're not going to put it as a credit, right? We're not charging the sales tax. We're giving the sales tax money back because originally, when we sold the product to him, right? So let's take a look, right? When we sold the product to him, we charged him for the full amount of sales. Now that he's paying and getting a 10% discount, therefore, the sales is actually discounted. So we need to give the portion of the money back because the sales is being discounted. Okay? So therefore, good. That's what we have to do. Now, what is he paying off? If he owes us money and now he's paying us, what is he paying us off?
Accounts receivable.
He's paying off his accounts receivable. Okay? So let's break it down. Let's start with the very first one is how much does he owe me? Okay? He owes me $135.31, right? Okay? So then now, okay, how much is the discount for? What can we discount? Okay, so let's take a look at his account. Can we discount sales tax?
No.
No. What can we discount?
We can discount the sales.
We can discount the sales. So in this case, $125. How much is the discount being offered?
15%.
Let's look again. Okay, sorry about that, guys. Um, so how much was the discount? 10%. So if I could give it 10% off of the sales of $125,
$12.50.
$12.50. Okay. How much sales tax do I have to give back from off of $12.50?
$1.03.
So how much money should I be receiving from customer B?
$121.47.
You're off. It does not match your 135.31.
$121.78.
I think. Oops. 121.78. Good. All right. Awesome. All right, and then our last thing we're gonna do here is make a note saying customer B paid in full. Okay. Received 10% discount. Okay. Awesome. Right? So any questions in regards to sales, sales returns and allowances, and sales discount?
No.
Okay. So like I mentioned, that is it for today. I would love to go over 6.4, but in this case, I'm going to leave that off for tomorrow.